Okay, I'll admit it. I'm a bit of a skeptic when I see a new product making the rounds on Wall Street. I've just been doing this a long time, and most of what comes out of that world is geared around what will sell. As an advisor, I get it, and frankly, that's what we get paid for, filtering through it all to figure out what has substance and what's actually worth investing in. Wall Street's product cycle often has themes, and one theme we've seen a lot of recently, and this in our view is a positive, are strategies designed to be more tax aware. Some of these strategies are overly complex and too costly, but there are two that have been making the rounds more recently that appear to have real potential and we find interesting. They won't be a fit for every investor, and both have their own set of risks and drawbacks, but both also provide potentially interesting solutions to problems investors have historically struggled with. They are also particularly relevant today because after years of strong markets, a lot of investors are now holding portfolios with large unrealized gains, often concentrated in just a few stocks. They'd like to make changes, but the tax cost of selling keeps them stuck. These two strategies are different answers to that same problem. How do you reposition without handing a big chunk to the IRS along the way? Okay, enough buildup. Let's jump into the two strategies. The first strategy is referred to as a 351 exchange. It's similar conceptually to what real estate investors do in a 1031 exchange, essentially swapping one investment or portfolio for another without triggering capital gains. For some background, the mechanics behind a 351 exchange are what have allowed ETFs or exchange-traded funds to be far more tax efficient than traditional mutual funds. Without getting too far into the weeds, the 351 exchange has been around for many years and is how ETFs manage fund flows without constantly triggering capital gains or losses every time new shares are created or redeemed by investors. From a big picture standpoint, the 351 exchange solutions currently being marketed are tax deferral strategies that permit an investor to make a one-time portfolio adjustment without immediately triggering a tax consequence. Situationally, where these would be the most likely to fit is for a taxable investor that has a portfolio of highly appreciated securities, and that investor wants to change how they are invested, but feels stuck due to the tax cost. For example, we see many investors today with portfolios that are overly concentrated in US tech stocks. Names like Microsoft, Amazon, Nvidia, and others. Those stocks have done extremely well, but that also means they make up a potentially large percentage of a portfolio. While big gains are a good problem to have, it likely means the portfolio risk level no longer aligns with the investor's desired risk. A 351 exchange could potentially help solve that. The investor could look to exchange some or all of their appreciated holdings for shares in a newly issued 351 exchange ETF, one that better fits their needs, current investment view, or just offers better diversification. Once the exchange occurs, they would own shares in the ETF with all their prior tax lots and unrealized capital gains, but the performance going forward would be whatever the return of the ETF is, not of the investments they contributed or exchanged into the ETF. It won't be a fit for every situation. In fact, not every portfolio will even qualify. In order to participate in a 351 exchange, the investor would need to contribute a portfolio that meets several criteria. Only cash, single stocks, and ETFs can be contributed, so no mutual funds or partnerships. No single stock holding can be greater than 25% of the total portfolio being contributed, and the top 5 single stock holdings can't collectively account for more than 50% of what is being contributed. In addition, there are other issues investors need to be aware of. To start, it's probably no surprise that these exchanges have started to come under more scrutiny by the IRS and the US Treasury. Investors obviously need to understand there are some risks and that rules could change. For example, one of the things that is tricky about the 351 exchange rules is that the newly created ETF is not supposed to have a plan to dispose of the contributed assets. Many that are being launched, however, appear to target mandates that all but guarantee the portfolio will have to make adjustments. Only time will tell, but it does feel like the government is bound to take a closer look at these. Another important consideration is that the investor really must want to be a long-term owner of the new ETF. The initial transition may not trigger capital gain, but if they want liquidity in the future, they will have to sell shares of the ETF, and that will result in gains. Given some of the legal and tax uncertainty, we have not yet utilized any of these exchange vehicles, but it's one that is definitely on our radar and worth monitoring. the strategy has potential to be a very good solution under the right circumstances. Let's switch gears and look at the second newish solution that we find interesting. There is no common industry naming convention like with the 351 exchange. We'll refer to it as a equity long-short extension strategy. Before we really get into what any of that means, it probably makes sense to take a step back and talk about a predecessor strategy that really formed the foundation for what we are seeing now. One of the big buzz terms in wealth management for the last 5+ years has been direct indexing. While I remember using a direct index strategy for a client more than 20 years ago, its adoption more broadly only picked up steam in the last 5 to 10 years. Most investors are already familiar with the index investing, where an investor buys shares of a mutual fund or an exchange-traded fund that tracks an index like the S&P 500. One investment holding, but instant diversification and exposure to the entire index. And minus a small management fee, the returns would track the index's returns. Index investing has seen explosive growth, and with that naturally comes some evolution. One of those evolutions was direct indexing. Rather than owning shares of a single security or fund that gave you exposure to an entire index, direct indexing allowed the investor to replicate the same index, but by directly owning all or a sampling of the underlying stocks of that index. Obviously, it comes with additional costs and complexities, but there are real advantages to it. It permits more customization, but the big one is it creates additional tax loss harvesting opportunities. When an investor owns a traditional index fund, the ability to harvest losses is limited just to periods when the entire index has performed poorly. The reality is that with something like the S&P 500, even in good years for the index, there are both winners and losers. In 2025, for example, the S&P 500 had a strong year, up nearly 18%, yet 171 stocks in the index actually declined. By using a direct index solution, an investor is now able to sell those losers and bank the losses, which can then create future tax savings. Like most things, direct indexing has some drawbacks. And the main one is that over time, since markets ultimately tend to move higher, a portfolio can become what is referred to as ossified. As markets go up, the opportunity to harvest losses eventually goes away, and the investor is left with a portfolio that typically has a higher management cost than an index fund, and also no longer resembles the targeted index unless the investor is willing to realize some gains to adjust it. With US equities performing so well over the last decade, this ossification issue became a bigger problem, and that is where the equity long-short extension strategy entered the picture. The summary description of this strategy is that it's essentially the direct indexing solution, but on steroids. In addition to taking an equity position that mimics something like the S&P 500, the manager will utilize portfolio margin or leverage to also buy additional stocks they think will outperform the index, and then also short ones they think will underperform, with the additional long and short exposures offsetting. For example, in what would be called a 150-50 extension strategy, for every $100 the investor puts in the strategy, the manager would buy $150 of stocks and short $50 of stocks. The net market exposure for the investor is still $100, even though they have positions that on a gross or absolute basis add up to $200. As an investor, the expectations are still to participate fully in the market returns, possibly even outperforming. But the big shift is in the opportunity for tax loss harvesting, both in the magnitude and the ability to have it continue on in a meaningful way. The additional capital being put to work results in larger realized losses than the typical direct indexing approach, and makes the direction of market returns less relevant. Whether the market goes up or down, opportunities for loss harvesting are expected to exist. As this chart shows, that ossification problem also becomes less of a concern. These are just estimates provided by one manager, but they show how quickly losses in a direct indexing solution diminish. Whereas in the extension strategy, they continue on and remain meaningful. This strategy is obviously more complex, does involve the use of leverage, and certainly costs more. It's not going to be for everyone, and currently account minimums on things like this are quite high. On the positive side, in our opinion, there is less uncertainty from a legal or tax standpoint. Long-short strategies have been around for a long time, but they've just been primarily focused on pre-tax returns, not tax efficiency or maximizing the tax benefits. We can send investment ideas and solutions all the time, And most of them we can discard pretty quickly or easily. But these two, frankly, caught our attention. They are at a minimum worth being aware of. And for any investor with a portfolio of highly appreciated securities that no longer fits their needs, these strategies may be game changers. Which brings me to the most important point. Neither of these is a yes or no answer you can get from a video. Whether a 351 exchange or a long-short extension actually fits depends entirely on your situation. Your gains, your concentration, your time horizon, your tolerance for complexity and risk, and how the tax math works out for you specifically. That's the part we take seriously at Smith & Howard. These strategies sit right where investing and tax planning meet. And getting them right means having the right people at the table. Investment and tax professionals working the same problem together. So something that looks good on the surface actually holds up against your full picture. The goal isn't to chase the newest trendy product. It's to make sure that if you use one, it's the right one for you, and that you keep more of what you've worked to build. If either of these could be a fit for you or someone you know, we'd welcome the conversation. You can reach us at the number and email on the screen.